Hello, this is Chad Carnes, the Chief Market Strategist at ETFGuide.com, and I want to spend a little time talking with you about Dow theory, a little bit about its history, a look at some of the charts, and see what it's telling us right now. Dow theory was created in the early 1900s by Charles Dow. It was a complement to his better-known creation of the Dow Jones Industrial Average. He recognized from an economic and fundamental standpoint that unless a lot of the companies in the Dow Jones Industrial Average were all moving in unison in a bull market or in unison in a bear market, then that trend was not very strong. So he came up with the Dow theory to support that claim that when the industrials go up, the transports should also be going up. And back then, the transports were primarily railroads, and since then have included more modern transportation methods such as some of the ground shippers as well as airlines. So his primary takeaway of Dow theory is that when the industrials are going up, so should the transports, and when the transports are going up, so should the industrials. That without shippers, you can't get products to consumers, but without industrials, you don't have any products to ship. So they're kind of tied hand in hand, and they both should be moving in the same direction. So now let's look at a chart of these two indices. And I apologize for the small size, but I want to get the history here. On the top, you have the industrial average in the top portion of the graph, and down in the second half is the transportation average. Both of these the Dow averages. And I want to point out the vertical lines and where they occur and what they are showing. In number one here, you have what's called a Dow theory non-confirmation. And that is actually what all these vertical lines show. And so what I mean by a non-confirmation is back in 2008, the transportation companies actually made a new high. After selling off in 07 with the market, they came back and made a new high in 08, which is a bullish breakout. But the industrials did not confirm that bullish breakout. So then you see what happened shortly afterwards in 2008. In blue, the number two, a few years later in 2011, again the transports made a new all-time high above almost around 5,500. But the industrials not only did not make a new all-time high compared to where it was in 07, they also were lower than where they were just a few months before, setting up for the sell-off, the rather fast and brutal sell-off in mid-2011 in July. The tables turned at point 3 with the black vertical line, where the industrials made a new high, a new 4-year high in 2012, but the transports did not. They were still well below where they were in 2011, which the bottom chart shows. The same thing occurred at point number 4 here, where the industrials broke out to a new high with the Fed and the ECB easing policies, but the transports are still not making any ground up and are indeed falling, and still continue to fall today. So let me show you one more chart which gets us updated to where we are today. The black horizontal line is what the Dow had to do to make a new high and thus justifying a bullish breakout in the Dow Jones Industrial Average. The red horizontal line at the very top at 5350 on the transports is where the transports needed to break out to have a Dow theory buy signal. Now, obviously, the industrials blew past their high when the ECB and the Fed announced their upcoming policies, but the transports have not even come close to making their new high, and they continue to show a negative downtrend while the industrials make new highs. This is a warning sign, a rather large warning sign, and I've heard a lot of people talking lately about how we should ignore it, how it doesn't matter, how the transports aren't a true representation of the market, etc., etc. But there's no denying that these non-confirmations in the past have resulted in sell-offs, some of them rather large, like 2008 and the summer of 2011, and should be warning signs right now. At ETFguide.com, we follow the Transportation Index and its tradable ETF, the IYT, as well as the Dow, the S&P, the TLT, silver, gold, the euro, and many other asset classes. We take a contrarian point of view a lot of times and try not to let the noise of the talking heads and news get in the way of our logic and data-driven analysis. Right now, the Transportation Index is telling us something. It is telling us that the economy is not as strong as everyone seems to think. We were ahead of this in August. Part of the reason is because of Dow theory and the non-confirmations that have occurred now for almost an entire year in the Transportation Index, that it's been showing weakness versus the industrials. This is not something that we should take lightly. This is a warning sign, and we need to heed the advice of what the transportations are telling us right now. For more information, come visit us at etfguide.com. We publish a monthly newsletter, and I also do a technical forecast at a minimum 2 nights a week. So please join us and check out some of our other YouTube videos as well.